Europe's in recession, and we can't think about the US in isolation.
How's it going, everyone? This is Daniel, and in this video, we're going to be talking about Cathie Wood and ARK Invest. So we're going to be talking about why Cathie Wood came out and gave a warning to the Federal Reserve. So she is against some of the strategies that the Fed is planning to implement to fight inflation. We're also going to be talking about exactly what is her advice to retail investors and for the people that invested in her fund. So we're going to be hearing from her, and we're also going to be talking about exactly what could potentially be happening next week, especially we have the FOMC meeting coming up. So make sure you stay tuned. We're going to be talking about all this important information in this video coming up. As you can see right here, we have the ARK Innovation ETF that's down 3.56% year to date. It is down 51.41%. So it was pretty bad year for Cathie Wood. So recently she came out and talked about exactly what investors, what retail investors should be looking at when it comes to investing in her fund. So she always talks about her horizon, her investment strategy is based off of a 5-year horizon. So when you look at the 5-year performance of the ARK ETF, it is up 82.96%. And when you compare it to an ETF, S&P 500 ETF SPY, 5-year performance is 71.88%. So she is outperforming SPY ETF by more than 10%. So on her recent interviews, she gave advice on people if they actually invest in ARK ETFs. She's definitely underperforming, and her fund is basically on a drawdown as we speak. So she talked about exactly to look ahead, and if you are somebody that got in recently or that invested in ARK ETF, to look at the big picture and just pay attention to the next few years, the next 5 years, because eventually investing in this fund is going to pay out. So that's exactly what she's been telling investors for a very long time. And also she talked about the economy and how the Federal Reserve, the way that they're approaching and controlling inflation, it's somehow wrong. If you've been following the channel, we talked about the US economy shrank 1.4% in the first 3 months of the year, raising recession fears. Cathie Wood talks about in the recent interview that she did that Europe is actually in a recession, and also China is also their economy is weakening. The Fed is definitely paying more attention to the consumer price index, the consumer spending, when it comes to how they're making decisions on interest rates hikes or etc. So we're going to go around and look at a detailed breakdown of what Cathie Wood had to say about how the Fed is handling the situation, how they should not be aggressive, and also she gave advice to retail investors on how to react to this massive drawdown, what to pay attention to, what are some important factors that she's also looking forward to the next few years. So we're going to talk about it. We're going to be hearing from her in this video.
Underperforming now, how are you explaining that? And what are you thinking about ARK's underperformance? And how do you explain that to investors who might be worried about
Well, you know, the investor who has been attracted to our strategies is a younger investor. I'll say it's across the spectrum, but the younger investors and the older investors who take us seriously about our 5-year investment time horizon, they're fine, because if you look at the past 5 years, we have outperformed NASDAQ, S&P, while I don't know what the number is, 75 to 80% of truly active managers have not. So we have that as a calling card, and we have a 5-year investment time horizon. We also give away our research. This is why we're investing in this space. And now we're playing more of a ground game, I would say. We're going to be publishing more of our models. So Tsla, we will put that update on GitHub next Monday, and we'll be tweeting, and our analysts will be doing videos so that our investors can understand the depth of knowledge that our analysts have, beyond the depth of knowledge, I think, of any other analyst in these technologies. The reason for that is we have organized our research teams by technology. There are 5 major platforms involving 14 technologies that are cutting across sectors. So they're technology specialists, and they are sector generalists. We think that's the right way to think about innovation. And I think that our investor base is reading our research, seeing the merit that it has, and they also understand how these innovation platforms are going to disrupt the investments in their base portfolios, their core portfolios. So they're using us at least for a hedge against those value traps.
So Cathie, you tweeted recently about the yield curve, so the difference between the 10-year Treasury and the 2-year yield.
Yes.
That inverted. So I'm reading from your tweet here, you say that is suggesting that the Fed is going to raise rates as growth and or inflation surprise on the low side of expectations. You say it's a mistake and that the Fed is playing with fire. So what do you mean there?
What I mean is when we saw the yield curve invert, and if you look at the 30-year to 2-year, it's a waterfall. It has come back a bit, steepened a little bit, partly because short rates have come down, which suggests to me that there are some people out there who might agree with us, who are saying, okay, the Fed, what's priced into the market right now is another 7 or 8 interest rate increases. That's priced in. And now they're saying we're going to be more aggressive than that. We'll go 50 basis points at a clip. We're going to get aggressive in terms of quantitative tightening, no longer quantitative easing. And so we're looking at consumer sentiment down at levels we have not seen since 08-09. Think about that. Record-breaking employment reports, record-breaking, unbelievably good. And yet the consumer is feeling terrible. 08, and no one's talking about this. You know, everyone who's saying, the economy's strong, the strong. No one's talking about a consumer sentiment. This is the University of Michigan consumer sentiment, suggesting that the consumer, which is 2/3 of our economy, is not happy and is actually depressed because their wage gains, income gains, are not keeping up with inflation. Their real income is dropping, and I think that the Fed has to watch out because we see auto sales coming back down, and everyone says, "Oh, that's supply chain." We see furniture stores, big disappointments. Restoration Hardware is a good example. One retail industry after another is saying, "Whoa, something's happening here." But the headlines out there, from a macro point of view, are not picking up those micro signals, nor are they picking up the consumer sentiment surveys. So we're just looking at the facts, and we're looking at all of the data. And the final piece I'll add is if you look at the inventory buildup that is taking place right now, partly because consumer demand is disappointing expectations, inventories can build up very quickly when the consumer goes on strike. So inventory to sales ratios might be low right now, but they can go up very quickly when the consumer says no mas.
Short-term inflation, things like you mentioned, higher sales, higher costs for consumers. Isn't that an inflationary environment? How would you explain that?
Yes, we've seen one supply shock after another. It went much further than I expected. I expected the supply chain bottlenecks after COVID to clear up in 6 months. It's been 2 years. All right. I didn't expect, we didn't expect Russia to invade Ukraine, which is the breadbasket of Europe. And it's the energy source for a lot of Europe. So those are two major shocks. I think Europe's in recession, and we can't think about the U.S. in isolation. Europe's probably in recession. China is, if we're looking at the micro numbers, China's very weak, very, very weak. And so everything's riding on the U.S. So the supply shocks, I think, are hurting purchasing power, as I said, in the U.S., could cause a recession. That will unwind the supply chain bottlenecks pretty quickly. And I think a lot of what we're seeing right now is a function of supply chain and supply shocks, very cyclical as well. And I think we'll see the other side of that. And then, as you say, we're seeing powerful deflationary forces associated with technology, artificial intelligence, training costs alone, and this is going to involve every industry, are dropping, if you consider both hardware and software, 60% per year. That's just one example of the deflationary undercurrents in the global economy. And so I think longer term, we're going to see significant surprises on the low side of expectations when it comes to inflation.
ARK Invest's best performing stock by far is Tesla. As you can see, 5-year performance, it's up more than 1,300%. So it has been killing it for ARK Invest. Unfortunately, there are some stocks in the ARK ETF that are getting crushed, like Teladoc. They're down 64.9% year to date, but still positive for 5 years. So if you held Teladoc for 5 years, you're going to be up 45.4%. 0.52%. So let's talk about exactly what to expect for Tesla and also for the overall stock market. Next week, we have the FOMC meeting, right? So we have Cathie that states that the Fed rate hikes that are coming up are priced in, but eventually we are going to be getting some form of volatility with the overall stock market. We have Jerome Powell that's going to be holding a press conference talking about how they are moving forward and what are their plans to potentially control inflation and how the world economy is going to, of course, affect the U.S. economy too. So that's going to be one of the most important things to listen to next week, of course. But however, for Tesla, we are going past the Twitter deal drama that's been going on with Elon Musk. He said he's done selling. So we're expecting Tesla to behave just as the overall stock market. So there is not going to be any external catalyst that is going to significantly affect it. It's basically going to be flowing with the overall stock market. If you get an aggressive sell-off, SPY, S&P 500, big tech companies, the NASDAQ tends to sell off. We expect also Tesla to potentially follow Ruth because we don't have any individual catalyst fluctuating the stock price that we saw this week. So that's going to be the main thing that we're expecting. Of course, I'm going to be keeping you up to date. So make sure you subscribe, turn on notification bell. And if you're new to the channel, subscribe. If you want free stocks, so check out the links in the description box below. But I'll catch you guys on another video. Have a wonderful day.